studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
In this slide, we introduce one of the most important corporate tax changes affecting private corporations that earn investment income. Historically, many business owners viewed active business income and passive investment income as largely separate areas of taxation. A corporation could operate a successful business, earn investment income on the side, and generally think of those activities independently. However, the modern tax rules changed that relationship significantly. As shown in the center of the slide, passive investment income is now measured against an important threshold: $50,000. This threshold acts as a warning line for corporate tax planning. When a corporation's passive investment income remains below $50,000, it generally stays in the green zone. In this range, the corporation retains full access to the small business deduction, often referred to as the SBD. This means qualifying active business income can continue to benefit from the lower small business tax rate. As passive investment income rises above $50,000, the corporation enters the warning zone. At this point, the small business deduction begins to be reduced or ground down. The more passive income the corporation earns above the threshold, the more access to the small business deduction it gradually loses. Eventually, if passive investment income reaches $150,000 or more, the corporation enters the red zone. At that level, access to the small business deduction may be completely eliminated. This can have a significant impact on the corporation's overall tax burden. The most important lesson from this slide is found in the comparison between traditional thinking and modern reality. Traditional thinking assumed that business income and investment income were separate. Under that mindset, investment income only affected the taxation of the investments themselves. But today's rules create a direct connection between the two. As shown on the right side of the slide, passive investment income can now affect valuable business tax benefits. In other words, investment income does not merely create investment tax. It can also influence the tax rate applied to active business income. This is why tax planners have become much more focused on monitoring passive income levels. Every additional dollar of passive income may affect more than the investment portfolio itself. It may also affect access to the small business deduction and increase the corporation's overall tax costs. The key concept at the bottom of the slide summarizes the entire rule. Passive investment income above $50,000 may reduce access to the small business deduction. And because the small business deduction affects the taxation of active business income, passive income has become a much more important planning consideration than it was in the past. This change is one of the reasons corporations must now be far more cautious when managing investment income, investment expenses, and long-term tax planning strategies. In this slide, we move from understanding the passive income threshold to understanding how the small business deduction grind actually works. The key idea is that passive investment income can create a chain reaction that ultimately increases the tax paid on active business income. Let's begin with the flowchart in the center of the slide. The process starts when passive investment income increases. As long as passive income remains below the $50,000 threshold, there is generally no impact on the corporation's small business deduction. However, once passive income exceeds $50,000, the rules begin to change. The corporation enters the small business deduction grind zone. As passive income continues to rise, access to the small business deduction is gradually reduced. This means a smaller portion of active business income qualifies for the lower small business tax rate. As a result, more business income becomes subject to higher corporate tax rates. and ultimately, the corporation pays more overall tax. Notice how this creates a domino effect. Higher passive income leads to a reduced small business deduction. A reduced small business deduction leads to less income being taxed at the favorable small business rate, and that leads directly to higher corporate taxes. The comparison between Corporation A and Corporation B illustrates this concept clearly. Corporation A earns $40,000 of passive income. Because passive income remains below the $50,000 threshold, the corporation maintains full access to the small business deduction. As a result, its active business income continues to benefit from the lower small business tax rate. Now compare that to Corporation B. Corporation B earns $90,000 of passive income. Because passive income exceeds the threshold, the corporation begins losing access to the small business deduction. Even if Corporation B has the same active business income as Corporation A, it may pay significantly more tax because less of its business income qualifies for the preferential small business rate. This is one of the most important planning lessons for modern private corporations. Two corporations can earn exactly the same amount of active business income and yet have very different tax outcomes simply because one corporation has higher passive investment income. The comparison at the bottom of the slide reinforces this point. The business income is identical. The difference lies in the amount of passive income earned, and that difference can translate directly into a larger corporate tax bill. The important insight highlighted at the bottom summarizes the entire section. A corporation can pay more tax on active business income simply because passive income became too large. That is why passive income planning has become such a critical part of corporate tax strategy. Today, investment income does not affect only the taxation of investments. It can also influence access to valuable business tax benefits and significantly change the corporation's overall tax position. Understanding this chain reaction is essential for anyone advising corporations that earn both business income and investment income. In this slide, we connect everything we've learned about investment expenses to one of the most important modern corporate tax planning considerations: protecting access to the small business deduction, or SBD. The key message is simple. Investment expense planning is no longer just about reducing investment tax. It is also about preserving valuable business tax benefits. Let's begin with the comparison shown on the left side of the slide. In this example, passive income has not been actively managed and has grown to $65,000. Because this amount exceeds the $50,000 threshold, the corporation enters the SBD grind zone. As a result, access to the small business deduction begins to decline. This creates three negative consequences. First, the corporation experiences the SBD grind. Second, it pays higher tax on active business income. And third, overall tax efficiency decreases. Notice the higher tax outcome illustrated at the bottom of the panel. Even though the issue started with passive investment income, the impact extends directly into the taxation of business profits. Now compare that to the right side of the slide. Here, passive income has been managed more carefully and remains at $48,000. Because the corporation stays below the threshold, it maintains full access to the small business deduction. The result is lower business tax, improved tax efficiency, and a lower overall corporate tax burden. The difference between these two corporations is surprisingly small. One corporation earned $65,000 of passive income. The other earned $48,000. Yet that difference can significantly affect the corporation's access to valuable tax benefits. The flowchart in the center illustrates why investment expense planning has become so important. The process begins with investment income. Next, deductible investment expenses are identified and properly applied. Those expenses reduce passive income. Lower passive income helps preserve access to the small business deduction. And preserving the small business deduction helps reduce the corporation's total tax costs. In other words, investment expenses can now influence much more than the tax on investment income itself. They may also help protect access to favorable business tax rates. The insight box at the bottom of the slide highlights perhaps the most important lesson in this entire section. Every dollar of passive income can affect more than investment tax. It can affect access to the small business deduction. That is why modern corporate tax planning requires a broader perspective than ever before. The Tax Planner Checklist provides a practical framework. Each year, corporations should estimate annual passive income, monitor the $50,000 threshold, review deductible investment expenses, consider future passive income levels, analyze potential SBD impacts, and project total corporate tax costs. The Tax Planner's Pro Tip summarizes the planning approach perfectly. Before claiming or allocating investment expenses, always evaluate how those decisions affect passive income levels, the $50,000 threshold, small business deduction availability, and overall corporate tax. The goal is not simply to reduce investment tax. The goal is to preserve overall tax efficiency across the entire corporation. And that is why corporations earning both business income and investment income must now be far more cautious and strategic than in the past.